Draghi is walking a tightrope. On one hand, he wants to signal confidence in growth outlook. On the other hand, he wants to signal that policy response will be overwhelming. Willem Verhagen, NN Investment Partners. President Draghi said the ECB would stay flexible and could modify its policy instruments for recovery. Why has the ECB decided to make little change?
So these expectations of future monetary policy come susceptible to bandwagon effects, and I think that that's what we're seeing in the market. I think Draghi is trying to walk a tightrope. On the one hand, he wants to signal confidence in the growth outlook because that will help to keep financial conditions easy. On the other hand, he also wants to signal that the policy response to this improvement in the growth outlook will be vastly underwhelming because his game plan is essentially to foster a feedback loop between falling real yields and improving growth momentum. In addition to that, the ECB is very well aware that unconventional policy has undesired side effects. It hurts the profitability of financials, of pension funds, and also political costs involved because savers in the core countries do not like low interest rates. Hence, as the recovery progresses and as financial conditions become easier because stock markets go up and credit spreads go down, policy becomes more accommodative, if you like. And that's why the ECB, in view of the costs of unconventional policy, feels that the parameters, to use Draghi's word, the policy parameters can be tweaked. And the simple translation of that is that there will be some form of tapering next year, even though it's pretty unclear what kind of form that will be. At the same time, Draghi emphasized prudence and gradualism in this process, and the reason for that is very simple. The inflation outlook remains very muted. There's no evidence of a self-sustaining upturn, so the ECB feels that the economy needs substantial monetary policy support for a long time to come.
Although Carney kept to the common theme, he made a speech and touched on inflation. This resulted in a sterling jump. Why did this speech cause the pound to jump?
Yeah, I think the Bank of England may not be too happy with the previous, slide in sterling because it is one of the main drivers which has caused the rise in UK inflation. And there is evidence that, this is because of higher import prices causing consumption growth to weaken. In addition to that, the Bank of England thinks that the economy is close to full employment. So persistently above target inflation could, sort of get baked into the cake, become permanently embedded in wage and price setting, even though there is no sign of that yet. But there are lags involved, and that's very much in line with the Bank of England's thinking. A third thing is that, they think that there could well be some fiscal easing by the new government. And of course, the external environment benefits from a robust global recovery. So these are the arguments why some on the MPC are inching towards a rate hike. But it should be weighed. All these elements should be weighed against, the vast uncertainty surrounding the Brexit and the potential for that to slow down UK domestic demand. And there's also some evidence for that. So far there is no sign whatsoever of a pickup in wage growth.
What was the biggest news to come out of this policy panel, and what should our viewers take away from it?
Well, I think, central bankers are becoming more confident in the global growth outlook because the global recovery has broadened out across sectors and across regions. It's more firmly entrenched with traditional laggards such as Europe and Japan catching up. And for them, one important implication of that is that there's less risk of disruptive exchange rate movements of the kind we saw in 2014 when the dollar started to appreciate strongly. A second element is that central bankers still believe in what economists call the Phillips curve, which means that if the unemployment rate goes down, at some point wage and price inflation will pick up. At the same time, they are grappling with the puzzle that, so far, even though the unemployment rate in the UK, Japan and the US is close to its full employment level, there is no sign of any clear acceleration in wage and price inflation. And that remains a puzzle for them. But I think the main message from the policy panel is that central bankers at this moment face a pretty difficult job. They need to balance robust growth, in some economies the possibility of labor market overheating, against continued low inflation, which may be driven by inflation expectations which have fallen below the target, even in the US. We can't be sure about that. And the third element, falling risk premiums. So how they will strike this balance between conflicting objectives, if you like, that will be very interesting to watch going forward.
Well, thank you, Willem, for speaking with me today, and thank you at home for clicking back. Goodbye for now.